And so I'm happy to invite Dr. Engelskirchen. Christoph, welcome
Hello,
for the
Johan. Hi. Hi.
outlook on on the general European car, uh, basically automotive market. Thanks again. I would like to say this for the whole audience to step in as at such a short notice. I think I called you yesterday afternoon. So thanks a lot, and it's all yours now. Please, if you can share the screen, then yeah, thanks.
Okay. Thank you, Johan, for the quick introduction. I hope the sound is good. I'm wearing my headset, which makes it usually even better than if I'm speaking into a different microphone. So I would like to start with a quote which resonated with me a lot in July 2022. So it's more than half a year old, and yeah, and it reads: the risks for the economy are overwhelmingly tilted to the downside. I think it's no surprise that it resonated to me or with me, yeah, in July 2022. And then what actually happened? The year 2022 wasn't really that bad in the end. And when there was the World Economic Forum in Davos earlier this year in January, people were talking about optimism. Yeah, people were talking about resilient economies. People were talking about tight labor markets. So it seems like, or it seemed at the point that we would go through all the turmoils and all the risks and all the gloomy scenarios, yeah, quite well actually. But now, if you look at what happened last week and this week in terms of banking troubles, SVP, but also Credit Suisse in Switzerland, you know, it does make sense to put that quote up again. Yeah. So risks for the economy are overwhelmingly tilted to the downside. There is little upside potential in the forecast that you will hear from us today and also from our colleagues, I believe. Yeah. So it's just something to bear in mind. But now enough with the negative, because we actually do see in our base case as well a strong start into the year 2023. And when we look at new car markets, we expect an expansion of around 10%. Yeah. I mean, you all know that after a contraction of 30%, yeah, versus 2019 levels, an increase of 10%, yeah, is probably the least that we would want to happen. But it's also something that we already saw happening towards the last quarter of 2022. So there was a year-on-year growth already during the last quarter of 2022. So it doesn't come as a surprise. And yeah, and you will also see when you're following some of these forecasts that they do vary quite a bit, yeah, which is always a bit concerning, right? So which forecast do you believe? How soft are these forecasts actually? But when you look at the institutions that are behind these forecasts, you can get a sense in why some are more conservative, why some are less conservative. As Johan said several times already today, nobody knows. Yeah, so forecasts are bound to be wrong in the end, but the spectrum of forecasts gives you a good perspective on what is likely to happen, yeah, this year. So our forecast, and we also do a diligent forecast regularly for new car markets, is a 10% expansion, yeah, this year. Why? Because supply issues are easing. China is reopening. Rental companies are replenishing their fleets. Order books are full. As you all know, if you are in the market to buy or working for an OEM, yeah, so you have good visibility of that. And there is a new point. I mean, not a new point, but a last point on this slide. There's new competition emerging from China, and a bit of a announcement of price war, some call it, or price cuts, and that usually means that people, OEMs, are in a position to provide more cars into the market, more supply. So this is actually good news from a new car market perspective. If we look at the used car markets, we expect some headwinds in 2023, not necessarily in terms of registrations, although markets will not expand like new car markets. So used car markets will not expand like new car markets in terms of registration numbers. But we do expect some headwinds in terms of residual value development. And the reasons are, well, they are two or threefold, right? So first of all, we have prices of cars around 30% higher than 2019. And this is not just plain price increases or list price increases. This actually happened via a combination of price increases, but also a shift from OEMs to more expensive variants, higher margin products, certain packages that were put into the car, and that also played a role in these hefty price increases. Yeah. We also see the supply of attractive used cars has been scarce for a while, and it's getting scarcer and scarcer. Yeah. And the question, at some point is, are people still in a position willing to pay these used car prices that cars are being offered for in light of that, ongoing supply shortage? So across the markets, I've put in here, we expect some downward trend for 2023, but it's not that residual values will be falling off a cliff. So 2023 is not a dark year for residual values. In fact, we are seeing that values are holding up moderately well, as you can see here on this chart. And if you're wondering, why we see here numbers like 119, 125, and up here I'm talking about, the first bullet, I'm talking about 30%. The reason is that on the bottom, or in this graph, we see a properly calculated price index. Yeah, so we are comparing like with like, so car with car, controlling for changes in mix. But of course, if you are shopping for a car and certain variants, certain trims are not made available to you, you would have to pay more money for certain cars, because the mix has changed quite a bit over the past 3 years as well. Last point on this slide, and we've had Slido questions around this, but if the market in 2023 moves into a volume push market, into pushing the metal market, then of course residual values could come under more pressure. But as I've said before, I think, and we think, it's unlikely that this would happen in 2023, because we still have a situation where demand outstrips supply on new car markets, and that's going to be supportive of residual values in 2023 as well. There are a lot of questions these days around Tesla and what their price cuts mean for them and also for the industry. And first of all, I would like to say that it's not the first time that Tesla reduces list prices, and you have been in the market, many of you, long enough to know this very well yourselves. So they have talked about their strategy as moving from innovators to early adopters before, and now they're talking about their strategy of moving to mass market adoption. Yeah. And they would be a company amongst very few companies that is then in a position to really compete for mainstream buyers when it comes to electrification. And that's a segment where a lot of brands are struggling to either launch a car into and also launch it at a price adequate for that segment. So I believe it is a credible strategy of Tesla. Of course, there are risks, like with any strategy. One risk is related to brand equity. And we all know that brand RVs are higher for premium brands most of the time. That's why we see established brands launching such premium brands into the market in search of higher RVs than for mainstream brands. So when we look at the table, and we need to differentiate when we talk about the impact on Tesla for the current used cars which are in the market. There, the impact would be it would put pressure on residual values, on absolute residual values, because new car prices are coming down for them, which means that the percentage RV is also under pressure. Technically, it's expressed versus the original list price. So therefore, a lower absolute RV translates into a lower percentage RV. And depreciation, there's a risk that it's higher than what was, historically anticipated for these models. So and that's the source of remarketing risk. On the other hand, for new Teslas that are being registered, that are being sold, that people take on asset risks now as we speak, the residual value absolute will again be slightly lower than what we currently see. That's a normal process when you lower the list prices, but your percentage RV will be higher and the depreciation as well will be lower, which is then a very positive situation for new car sales. It's positive for TCO. It reduces the impact of the higher finance rates. So it's actually a wise strategy if it is a credible one, right? So if Tesla is actually moving from premium to mainstream, and that's what they said. It's definitely the better strategy than pushing volumes via short cycle channels or pushing volume via discounts. Yeah, so we have to acknowledge that. And in terms of what does this mean for competitors, for the market, so the first dash, under the last bullet of this page reads that the new BEV transaction prices will likely come down. It's not just because Tesla chose to reduce list prices for their models. It is also because governments are taking incentives out of the market, and somebody has to, pay the price and pay the gap or cover the gap. And with, users and car buyers being more and more stressed, in terms of what they can afford with inflation and cost of living rising, there is a point here that BEV transaction prices for new BEVs will come under pressure. And we've seen some manufacturers already announcing that they will not rise or increase prices this year. Well, possibly they will have to think about ways of lowering them. When they want to do this, they can of course lower the list prices, but I know, and we all know, that it's a delicate discussion to be had, because if you're moving away from the list price position that you currently have, if you're a premium brand, you are at risk of losing that premiumness in your price positioning. So alternative ways are to hide discounts in leasing rates, or hide discounts in certain packages, but not make it transparent that these cars are sold at a discount. I mean, that's really important, I think, in the discussions at OEM level at the moment. We also believe that mainstream brands will likely be more affected by this, some have called it price war, I put it in brackets though, than premium brands, because we are moving or entering a segment which is more price sensitive. And if if some manufacturers or if governments decide that they take a more difficult stance with these customer groups, then there is a bit of a risk that prices will have to come down further in those segments. I do want to end with something positive, and it starts with this slide here. And let me walk you through the charts that are shown here. So on the top left, you see a registration forecast for passenger vehicle registrations from IHS. And if you look at the numbers, you could say, wow, that's pretty stable. It's not the most aggressive forecast that I've seen. For new car markets, it's pretty conservative. We will not hit 2019 levels for a very long time. So let's take this and then let's add the estimated leasing share development over time. And if we are, we should have said also PCP share over time. We've heard that PCP and leasing, they are really strong and have strong shares in some of the markets. We believe it's going to rise further because OEMs and leasing companies, they want to keep close to the customer. It's really important for them to have them return after 3-4 years, because it lets them control the customer to a certain degree, but also the remarketing volumes. If you add these two up, you see rising registration for leasing offers, yeah, and cars registered as leasing cars or PCP cars. So why is this actually good? And this is my last slide. So this is actually good because it drives remarketing volumes up. And this is important, for everyone that is in the market to earn money with remarketing. It creates an opportunity to professionalize price setting and pricing intelligence. And it's just a good outlook, which will come, to effect a little bit later than this year, yeah, because we've seen the dip in new car registrations, but it's overall a positive outlook in terms of remarketing business over the next 6-7 years. With that, Johan, over to you.